Okay, we're doing a quick review of the portfolio today and also asking the important question of how much lower does this market have to go for there to be a bottom? What more do you need to see a bottom? What are the reasons for the market going lower? Please put them in the comment section below. I'd really like to know. We can go through a list of the most recent arguments posited by the bears, which are, higher interest rates. Well, we've already priced that in my opinion. A negative downtrend in the market. We had the last video that we did on the Nasdaq was showing how the Nasdaq may have bottomed. That was in our previous video. And here you can look at the S&P. Look at it on a chart. Yes, we're a few points away from that high, but we've still reached that close enough point of the old highs on the S&P, the pre-corona highs, to justify a bottom, in my opinion. The 200-day moving average was tagged there. See the orange lines, the 200. The RSI was oversold. Every time it reaches oversold like that, usually bottoms occur after. See the bottom of the market, oversold. Okay, this was a consequent bottom here in the market temporarily. But we've been riding along the 200-day moving average for a while now, and I can understand everyone's angst in the current environment about rising rates. And now you have these recession fears because of the bank failures and the contagion fallout from that. But at some point, you have to buy things when they're low enough, which if the market is 20 to 30% off the highs, which is what the S&P and Nasdaq were at one point, then you just have to buy it anyways. I mean, it doesn't really matter what the problem is. That's a huge pullback, 20 to 30%, and you have to buy these things. So let's also look at the VIX. The VIX had a big spike, but it's pulled back since. Volatility is remaining above 25, but if you were to reverse this chart in the other direction, that would look like a bottom. So this looks like sort of a top in the VIX. I could be wrong, but I'm not here to predict anything. It's just when the VIX is high, time to buy. When the VIX is low, time to go. And here it's rather high. This would be typically a good time to buy because the VIX highs correspond with market lows traditionally. So if you think the worst is out of the way, then volatility will probably decrease and the VIX will fall and the market will rise. And that's why SVOL is a decent play. And a lot of people are excited about that. I have a small amount in it, as you've seen in my portfolio. We'll get back to that in 1 second. SPY, so again, on a 1 year, we're trying to hug this 200-day moving average. And we held that support at 380 like we had already said many times on our prior videos. This would be the next stop down. So far, we're holding it. We're trying to hold the 200 as well, like underneath. All the moving averages are holding tight, hanging in there. They act sort of as a magnet to the stock price. So there's also a lot of volume that came in and bought recently, and that's usually a good sign of a bottom when volume is higher than normal, and in buying volume was. So yeah, there's a lot of selling volume, but there's there are a lot of equally smart people buying at the same time. And again, why wouldn't you? We're off 20% from the highs. We're consolidating on the 200-day moving average. The market averages 7% a year. So let's just look at it on a $10,000. Well, let's look at it a full chart here from 1995 to now. Okay, we'll start it here at 90. Let's say 98 at this gray line, which is $100. Okay, so $100 to $200, and then $200 to $400. That's 200%, correct? Well, over 20 years, if you do a 7% return that the S&P averages per year, and you could add in 2% for dividends, so let's just give it a nice 10% even number. 10% for 20 years is 200%. So we're right in line with what it should be averaging per year. Now that we've fallen to 400. So, because that's from 100 to 200, that's 100%, and then 200 to 400, it's another 100%. Again, so you divide that by 10 over the last 20 years, and that's 200%. 10%, 20 times. You do the math there, and it might be a crude sort of math for you, but that's just one metric I'm using to see that, okay, we're justifiably at a low that you could buy. Anytime the market's 20 to 30% off the highs, I mean, what else are you going to buy? What are you waiting for? 40 to 50% of the entire stock market's history, out of its entire history, you're looking for a 30 to 40, you're looking for a 50% drop. I mean, that would be so fortunate if you could get that. 20 to 30% seems good enough for me. Let's go check out the portfolio. We're up, 8,700 before. Now we're up 8,400. So it's not about the money. It's about, because we've lost so much. Look, we were at 433 a month ago. Now we're at 333. So it's not about the money at all. It's about the percentages. 1.45. Are we in line with the market? And 145. You see up top, the Nasdaq is up 0.2, the S&P up 0.68, and the Dow's up 0.97. So we're beating the market once again. How are we doing it? Because we transferred our money into these index-related plays and got them out of leverage. So, if there was a fund, like a bond fund that had leverage, or some other type of ETF that had leverage, like pipelines, AMSA, down here, we cut it in half. All these $5,000 and $4,000 lots on the sides here, they used to be about 10,000. We cut them in half because they have leverage of some kind. And then we switched to the indexes. UPRO and TQQ have leverage, but it's a different kind of leverage. It's not, leverage that they have debt on and have questionable assets on or whatever. If they were to if they were to have to raise capital before maturity of these assets, no, it's a different kind of asset with leverage with UPRO and TQQ, but they are index related. So I went more pure into index related funds. Cornerstone Index, JEPI Index, RYLD, BDJ, USA, BST, UPRO, CSQ, TQQ. Those are all indexes. And then you start to get to RIV and GOF, and it's more bonds again. SHI is convertible securities. It's like an index. It moves like an index. EOS moves sort of like the tech index as well. I told you we added that last Friday because that was a one way to play NASDAQ because we see the NASDAQ as a good opportunity right now. It's bottomed, in my opinion, already at 250 because we just made a video on that. Same case we just made for SPY about needing to reach pre-corona highs. NASDAQ did the same thing. So we cut all these things in half. Our margin debt our margin debt here is 239. We have 10K short and triples. We also have this 5K short in Cornerstone, and we're losing on it now, and that's a good thing because Cornerstone is coming back. We did concentrate a lot of money into Cornerstone, as we said in the past video. We've just been adding to that because it's has the highest dividends, and it allows us to get these strong monthly dividends, which are about $8,000 a month. So this is due to Cornerstone mainly. You see Cornerstone dividends here, 3,500, 30, so 32, so from CLM, CRF. And they're 4-star. It's a 4-star fund on Morningstar. And Cornerstone beat the S&P and Schwab D, SDHD, which everyone loves. It beat it on a $10,000 test on Morningstar. Go look it up. I have already done, or go look at my past videos on Cornerstone. I've showed it numerous times. I want to go to it now, but I don't have time. So we're up 5%. We were only up 4% last week, but we've kind of stemmed the tide of the losses here, and we're only up 5% now, but we've improved from 4%. And the Nasdaq's up 11, S&P is up 2, so we're right in the middle, which is what I always want. Hopefully we can start recovering those losses faster though as Cornerstone bounces. I'm not relying on Cornerstone's price performance either. I don't care about that. All I care about is the dividend, because if I hold in Cornerstone for 5 years, 20% dividend cash flows the investment, so it'll be all house money after that, free money. So we go to Cornerstone. You see it's trying to bounce here off the bottom. It was at yearly lows. I mean, this was a textbook buy if I ever saw one. You hate to short it around these lows, but I did it just for protection. You never know. See, this low coincides with this low and almost this low as well. So it's, this is and we were deeply oversold. I showed that in the last video. So now we're coming off these lows. Again, it's not a hope equation, a hope deal. I'm not hoping. It's not a good investment strategy of hope. I hope this continues. I'm just collecting the dividend, 20% dividend. But we're at this low, bouncing off these lows. It seems like a good time. $10 does seem like the next stop, in my opinion, for Cornerstone. It's the next resistance here, the next resistance level. We're oversold again, and look, this is a quality fund, 4 stars on Morningstar. It has the S&P 500 holdings in it, and it has the Nasdaq holdings as well in CRF. So I'm confident about these funds. Look, we're up 9,000 now because most likely due to Cornerstone. Yeah, 2% now. So and if I lose on my short, again, that's great. We added a substantial amount to Cornerstone recently, so. Anyway, so that's the overview. I wanted to not only review the portfolio, but show you a general macro level view of the market. We briefly discussed interest rates, about how we've already priced that in, and the Fed's even going to get more dovish as this SVB bank fallout is forcing them to be more dovish, and perhaps only hike rates 25 basis points this week, and perhaps not even raise rates at all. But they'll probably have to raise them 25 basis points to keep credibility. And so are available for withdrawal, by the way, it's back up to 89. It was getting low. It was getting towards 80. In a few months, I'm going to receive a loan, by the way, just full disclosure, and my account will probably increase by about 30K. But hey, these loans, I get them off of my dividends. I get to pay them back. So you're going to see my account grow there, and you'll see my margin level shrink to basically 200, because 10K is short. So if I get 30K off this loan, which I'm in talks of getting right now, then I lower my margin to 200. My account will grow to 364 in a perfect world. I'm just giving you full disclosure in case you follow closely. Anyway, that available for withdrawal will go from 89 to 120. So that would be a good cushion, so I avoid margin calls. This is all about avoiding margin calls, and just staying, having enough equity cushion to stay in the game and withstand market downturns. And we did that in 2022. I just want to make sure this continues, and so I get these loans and then I pay them off. Basically, I pay off my margin earlier by getting these loans, and then all my dividends go to my paying back my loans. So I think that's the fastest way to grow your account, by the way, because you get to qualify for loans through dividends. You can't qualify through stock gains. No one wants to work with you on that level. So anyway, and also we've concentrated some money into these triple, let's say small and mid cap names that were big winners. This is the Russell Triple. We have Soxel, which made about $1 million, more than $1 million. I want to say $1.8 million on 10,000 invested on Morningstar. If you go look up that test, it's really interesting. I might do just a whole video dedicated to Soxel, but it decays a lot. It's a risky name. That's why I only have 2K in it. But Soxel, I've reloaded into these triples so I can get back my performance, because we're up 30% for the year. Now we're only up 5. We were up 30, and we had to sell out of a lot of these bond names and things that we took gains on, but we just lost the performance. That's all. We didn't lose much. We only made a small amount of money at the end because we didn't take the gains at the top. We took them near the bottom because we didn't want to lose the income. So we never took them near the top. And I don't feel like I shoulda, woulda, coulda, because, again, who could have predicted the SVB bank issue, a run on the bank, essentially? But, and to where you have to question where these banks get their money from, so, and these funds even that I'm invested in, where do they get their money from? What is their true balance sheet like? So you just have to scrutinize these funds and companies closer where they get their sources of funds from, and these mutual funds and ETFs, everything. It is a pretty spooky event. It could have been big, but the FDIC has reassured everyone that the depositors are safe and all these kinds of things. Outflows have stabilized. People don't talk about that much, but according to someone at the White House, I heard it on CNBC once last week. I forgot who it was, but they said that outflows have stabilized at most of these banks. And that hasn't been reported on too much, as well as the strong GDP number last week. It was about 3% GDP from the Atlanta Fed survey, I want to say. But go check these yourself if you want to verify. A lot of bullish things are setting up for the market, in my opinion. So you have the price action on the 200. I just showed you for these funds. The Russell is back. If you want to see something interesting, just look at where the Russell is. I mean, it's back at 2019 highs. If we go into the chart, I already showed you a chart, but I just wanted to reemphasize that one more time, that if you look at a chart here of the Russell 2019, that gray line it's up against. So here we're below the gray line. Okay, we're right at it now. This is, I think, a good time to start a position. The RSI is at 40. It's a good time. When else are you gonna buy these things? So anyway, so that's the point of the video, is when else are you gonna buy? What else do you need to see for it to be a bottom? How much worse could things get if the FDIC insured things, if the interest rate situation is already priced in, and the Fed's getting more dovish? What else do you need to see? Okay, please leave comments in the section below if you like, and I'll talk to you soon. Thank you.